Welcome back for another deep dive. This time we're really getting into the nitty-gritty of Morgan Housel's The Psychology of Money.
It's a fascinating look at, not just like the numbers and the investing strategies, but the human side of it all.
Yeah, right. Like how do our emotions and our past experiences and even our biases play into our financial decisions?
Exactly. And, Housel does a brilliant job of using stories and anecdotes to really bring those concepts to life.
Oh, absolutely. Remember that story about the tech millionaire who was making terrible financial decisions despite being super successful?
Oh, yeah. Yeah, that one was a real head scratcher. I mean, here's this guy swimming in cash, but still making risky bets and just not really managing his money well.
Yeah, it really makes you think, right? What's the disconnect between knowing about money and actually being smart with it?
Right, and that's where this whole idea of money history comes into play. Housel argues that our views on money are heavily shaped by our past experiences.
Makes sense. If you grew up during a recession, you'd probably be more cautious with your spending.
Exactly. Or someone who lived through a period of hyperinflation might be more inclined to invest in assets that, hold their value.
Totally. My grandparents lived through the Great Depression, and to this day, they save everything.
Yeah, every little scrap of aluminum foil, every rubber band.
Seriously. So the point is, there's no single right way to think about money, right?
Exactly. It's all about understanding these different perspectives and how they influence our behavior.
It's like we all have these invisible scripts running in the background, shaping our money choices without us even realizing it.
Absolutely. And that's part of what makes this book so insightful. It helps us decode those scripts.
So it's less about crunching numbers and more about recognizing the psychological forces at play, right?
Exactly. And speaking of forces that we don't always see, Housel also dives into the roles of luck and risk.
Oh, this is a good one. I love how he uses that story about Bill Gates and his high school friend Ken Evans.
Yeah, it's such a powerful example. Both were brilliant students, driven, talented.
But only one ends up becoming a billionaire.
Right, and that's where House Talent challenges us to consider the role of luck. How much of success is attributable to skill and hard work versus just being in the right place at the right time.
It's like flipping a coin, right?
Yeah.
Sometimes you get heads, sometimes you get tails.
Exactly. And focusing only on the Bill Gates of the world can create this distorted view of success.
It's like we're only seeing the tip of the iceberg.
Precisely. So it's crucial to factor in those elements of chance and risk, both in our own lives and when we're evaluating the success of others.
Totally. It's a good reminder to not be too hard on ourselves when things don't go as planned.
Absolutely. And on the flip side, not to get too cocky when things are going well, right?
Humility is key, for sure.
Exactly. And, speaking of things we can control, Housel also talks about the power of compounding.
Oh, yeah. It's like the eighth wonder of the world or something.
Right. He uses this really fascinating comparison between Warren Buffett and hedge fund manager Jim Simons.
Oh, yeah, I remember this. Simons had these incredibly high annual returns, but Buffett's wealth is still exponentially larger.
Exactly. And that's all thanks to time and consistency. Buffett's been in the game for 70 years.
Wow. So even though Simons might have higher yearly returns, Buffett's consistency over decades has allowed compounding to really work its magic.
It's like the tortoise and the hare, right? Slow and steady wins the race.
Love that analogy.
Housel also compares it to tracking the progress of hard drive capacity. For decades, it grew slowly, then boom, exponential growth.
So it's like sometimes those big leaps happen in bursts, making it hard to grasp the potential of long-term growth in advance.
Exactly. And this applies to investing, too. Patience and consistency are key.
And to really drive home the importance of consistency, Housel tells that cautionary tale of Jesse Livermore.
Ah, yes. The legendary trader who made and lost fortunes multiple times.
What was the deal? Was he just super unlucky?
I mean, he was brilliant at reading the market, no doubt, but he struggled with emotional discipline.
Ah, so he had the knowledge and the skills, but not necessarily the temperament.
Exactly. He had winning strategies but couldn't stick with them consistently, which ultimately led to his downfall.
So it's not enough to just have a good plan. You need the mental fortitude to see it through.
Exactly. Even the best financial plans will inevitably face periods of underperformance.
The key is to have the resilience and the patience to ride out those downturns.
And that, I think, leads us perfectly into the importance of what Housel calls room for error.
Okay, I'm intrigued. Tell me more about this room for error concept.
Well, he uses this clever analogy of blackjack card counting. Skilled card counters don't win because they can predict every card.
They win because they manage their risk and give themselves a buffer.
Exactly. They know they won't win every hand, so they bet strategically to stay in the game long enough for the odds to tilt in their favor.
So it's like they're playing the long game, knowing that there will be ups and downs along the way.
Precisely. And this translates beautifully to personal finance.
Like having an emergency fund, avoiding excessive debt. Those are all ways to give yourself that room for error.
Exactly. It's like having shock absorbers on your car. They don't prevent you from hitting bumps, but they make the ride a lot smoother.
It's about creating that financial cushion that allows you to weather those inevitable financial storms.
Precisely. It gives you the flexibility to adapt and make smart decisions, even when things get tough.
I'm loving this. Okay, so we've talked about money history, the role of luck, and the importance of building in a margin of safety.
And all of these factors are intertwined, right? They all contribute to how we navigate the often complex world of money.
It's like we're starting to peel back the layers of the onion and reveal the hidden forces that shape our financial lives.
And that's just the beginning. There's so much more to uncover in the psychology of money.
I can't wait to dive deeper.
And speaking of navigating uncertainty, that's where Housel brings up this really interesting idea about being reasonable with your money.
Okay, I'm listening. Reasonable versus what?
He says sometimes it's more important to be reasonable than to try to be perfectly rational.
I'm not sure I follow that. Those sound kind of similar.
Yeah, it's a bit nuanced, but to illustrate his point, he uses this historical example about Julius Wagner Jareg, the doctor who won a Nobel Prize for a pretty controversial treatment for syphilis.
Wait a minute, wasn't that the guy who intentionally infected people with malaria?
Yeah, that's the one. It sounds crazy, right?
Super counterintuitive. Like you're
Yeah.
fighting one disease with another, even worse one.
Right, but his reasoning was that high fevers sometimes seem to help fight off infections.
So he thought, well, let's just give everyone a fever.
Yeah, basically. And his observation wasn't wrong. High fevers can sometimes help, but obviously the treatment itself was pretty risky.
Understatement of the century.
Right. And that's kind of Housel's point sometimes in finance, just like in medicine, aiming for perfect mathematical rationality can lead you down these weird paths.
So it's like you could have this super complex investment strategy that might yield slightly higher returns on paper, but in reality it stresses you out so much that you can't stick with it.
Exactly. Sometimes a simpler approach that you can actually maintain, even if it's not perfectly rational from a purely numbers standpoint, might be the better overall choice.
It's like finding that sweet spot between what your spreadsheet tells you and what you can actually handle emotionally.
Exactly. It's about sustainability in the long run.
Makes total sense.
Yeah.
Okay, so we've got money history, we've got the role of luck, and this idea of being reasonable over always trying to be perfectly rational.
Now hold on to your hats, because Housel throws another curveball, the power of narratives and how they influence our financial decisions.
Oh boy, I can already sense this is going to be good. Hit me with it.
All right, imagine an alien visiting Earth in 2009, right after the 2008 financial crisis.
Okay, I'm picturing it now. Little green guy antennas in all hand. What's he seeing?
Well, he's observing all this economic turmoil, people freaking out, losing their jobs, markets crashing.
Right, makes sense. It was a crazy time.
But here's the thing, materially, not that much had actually changed from just a couple years earlier in 2007.
Wait, so people still had their homes, jobs, cars, all that stuff?
For the most part, yeah. The actual economic reality hadn't shifted all that dramatically.
So what caused this massive swing in sentiment? What changed?
The stories we were telling ourselves.
Uh-huh. So in 2007, the dominant narrative was all about economic stability, ever rising, housing prices, endless prosperity.
Exactly. But by 2009, that story had completely unraveled and been replaced by fear and uncertainty.
Wow. So even though the underlying economic reality hadn't drastically changed, the shift in the narrative had this huge impact on people's choices and actions.
It's a powerful example of how these narratives can be incredibly seductive, especially in times of uncertainty.
They can lead to overconfidence during the good times and then excessive fear when things start to go south.
Exactly. And that fear can really cloud our judgment, leading to bad decisions.
Okay, so how do we protect ourselves from getting swept up in these narratives? How do we learn to see through the hype and the fear?
That's where critical thinking comes in. Housel says, don't just blindly accept whatever the prevailing narrative is, especially those being pushed by people with vested interests.
Right, like those financial gurus promising you'll get rich quick.
Exactly. Question assumptions, dig deeper. Seek out diverse perspectives to form your own informed conclusions.
So it's like we talked about before, recognizing our own biases and how they might be coloring our perceptions of money and financial success.
Absolutely. Self-awareness is key. We need to be aware of the stories we're telling ourselves and be willing to challenge them.
And I guess this all circles back to Housel's main point, that there's no one-size-fits-all approach to money.
Exactly. What works for one person might be a disaster for another.
So we need to figure out what works for us individually based on our own values and goals.
Right. He even shares his own personal philosophy in the book, which is all about prioritizing independence and freedom over maximizing returns.
Oh yeah, he talks about how owning his house outright, even if it's not the most financially rational decision, gives him a sense of peace of mind.
Exactly. So it's about aligning your financial choices with your values, even if they go against conventional wisdom.
It's not about keeping up with the Joneses. It's about finding your own path to financial well-being.
And that path might look totally different for each of us.
Wow, this has been such an eye-opening conversation. I feel like I'm looking at money in a whole new light.
Right. House really has this way of making you question everything you thought you knew about, like wealth and success.
Absolutely. He goes way beyond the typical financial advice and gets into the nitty-gritty of our psychology and our emotions.
It's refreshing, isn't it? Because let's face it, most of us make financial decisions based on a whole mix of factors, not just cold, hard logic.
Totally. So as we wrap up this deep dive into the psychology of money, what are some key takeaways for our listeners? What are the nuggets of wisdom they can apply to their own lives?
Well, I think one of the most important things Housel emphasizes is understanding your own money history. What experiences have shaped your beliefs and attitudes towards money?
It's like becoming an archaeologist of your own financial past.
Exactly. And once you've dug up those beliefs, you can start to examine them. Are they helping you or are they holding you back?
It's about becoming aware of those stories we tell ourselves about money and then deciding if they're stories we want to keep telling.
And along with that, I think Housel's emphasis on long-term thinking and patience is crucial. Remember the power of compounding. It's a slow burn, but the rewards can be huge over time.
It's so hard though, right? We live in a world of instant gratification.
It takes discipline, for sure.
Yeah.
But the tortoise and the hare, remember, slow and steady wins the race when it comes to building wealth.
And speaking of weathering the ups and downs, Housel's idea of room for error really resonated with me. It's about acknowledging that life is unpredictable and giving yourself a buffer.
Exactly. Whether it's an emergency fund or avoiding excessive debt, those are all ways to create that margin of safety.
It's like having that extra layer of protection so you're not completely thrown off course when life throws you a curveball.
And finally, I think it's so important to remember that financial success is not a one-size-fits-all thing. What brings you peace of mind might look completely different from your neighbor's version of success.
It's about defining what matters to you and making choices that support that vision.
And on that note, I want to leave our listeners with this final thought from Housel himself. He says, the most important part of every plan is planning on your plan, not going according to plan.
It's such a great reminder that we can't predict everything. The key is to be adaptable and willing to adjust course when needed.
It's not about having a perfect plan. It's about having the resilience to handle whatever life throws your way.
Well said. And on that note, I think it's time to wrap up this deep dive into the psychology of money. Thanks for joining us.
It's been a pleasure.
We hope you've gained some valuable insights and maybe even a new perspective on your own financial journey. Until next time, keep exploring and keep those financial brains firing.